So is Bitcoin going to hit 100 grand, half a million, maybe even $1 million? I mean, it's the question on everyone's mind. But what if I told you that the price target doesn't matter one bit if you're asking the wrong question in the first place? Today, we're going to break down exactly why tying a volatile asset like Bitcoin to a hard deadline is basically a ticking time bomb for your biggest life goals.
Okay, so let's make this real. An investor I know came to me with this exact plan not too long ago. He's looking at the charts, and he's convinced the price in 5 years is going to be way higher than it is today. So the strategy is simple, right? Buy now, hold for 5 years. By then, he'll be married with his first kid on the way, and then cash out to get a down payment for a nice house and a great school district. It sounds like a pretty perfect plan for the modern world, doesn't it? But is it really? This is where a plan that looks absolutely flawless on paper can actually be a complete disaster waiting to happen. See, the question isn't whether Bitcoin will go up over time. The real question is whether this strategy is a smart move when your family's future is literally on the line. And that brings us to the first huge idea we need to talk about: the deadline trap. This is that hidden risk, that little detail that so many smart investors just completely miss when they start mixing their major life goals with these high-flying, high-beta assets.
It's funny how we think about this. Investing sounds smart, responsible. Gambling sounds reckless. But here's the thing. The real difference isn't the asset you're buying. It's the timeline you're stuck with. See, true investing gives you the power, the flexibility to wait out the bad times. But gambling? Gambling forces your hand. It says you have to win by a certain time or you lose.
So here's the key takeaway. The absolute moment you say, I have to sell this thing in 5 years, your entire logic is broken. I don't care if it's Bitcoin or Nvidia or any other hot asset. You're not investing anymore. You're gambling. Gambling on a specific time window that you have absolutely zero control over. This really forces us to redefine what risk even means. It's not just about the price jumping up and down. No, the real risk is actually something far more personal than that.
And this chart just illustrates the point perfectly. I mean, look at it. You take something like the S&P 500 or gold or Bitcoin, and you zoom out. Over a long enough period, they all have this beautiful upward trend. The data tells us that if you can just stomach those terrifying drawdowns and just hold on, you'll eventually hit new highs. The long-term risk is actually surprisingly low. But that is the million-dollar question, isn't it? How long is long enough? 5 years feels like an eternity, especially in crypto. A lot of people think, hey, that's a whole halving cycle. I can for sure cash out by then. But the honest-to-God truth is, nobody on this planet can guarantee that your 5 years is the market's long enough.
And this, right here, is the heart of the deadline trap. Now look, I'm not saying Bitcoin won't be higher in 5 years. Personally, I think there's a really high probability that it will be. But that's not the point. The point is, at that exact moment when you need to make the call to the bank for that down payment, is the market going to be at an all-time high, or is it going to be in the middle of a gut-wrenching 40% correction? Nobody knows. And your long-term thesis doesn't help you one bit when your deadline is tomorrow.
This leads us to an even bigger hurdle, because even if the market does what you want it to do, your own mind can become your absolute worst enemy. So let's just imagine this scenario. You set a really clear goal. You tell yourself, I'm going to sell the moment Bitcoin hits $150,000. It feels disciplined. It feels like you have a solid strategy. You picked your number, and now you just sit back and wait. But then this happens. The price just rockets upward. It gets so close, it touches $149,000, and then it stalls. It starts to drift back down. It never quite kissed your magic number. So what do you do now? You're completely trapped. I mean, if you're not willing to sell at $149,000, what makes you think $150 is guaranteed? And that's when it hits you. You realize that your target price was just a guess, a completely arbitrary number you pulled out of thin air. That's not a disciplined strategy. It's a recipe for anxiety and, usually, some really bad decisions. So, if hard deadlines are a trap and price targets are just a guess, what's the solution here? Well, it all comes down to one simple golden rule that separates the successful long-term investors from the gamblers. You have to, at all costs, avoid a forced liquidation date. This is it. This is the single most important prerequisite for making real money in volatile assets. It means you only put in money that you can afford to hold, maybe forever. You hold it until your original thesis plays out, on the market's timeline, not yours. And let me put it even more bluntly. This is what you're doing. When that down payment or that tuition bill is non-discretionary, meaning you absolutely have to have that cash on that date, you are not investing for your family's future. You are walking into a casino and betting it all on red. Now, hang on. This doesn't mean borrowing money to invest is always a terrible idea. It's all about what you're borrowing against. If you're borrowing against guaranteed future cash, like a pension or a super stable salary, you're really just pulling forward your own future money. That's a solid bridge. But if your only plan to pay back that loan is hoping the asset goes up in value, well, that money doesn't belong to you yet. It belongs to the market. And that is a very, very shaky bridge to be standing on. Okay, so let's bring all of this home. It really boils down to two simple but unbelievably critical questions that you have to ask yourself before you buy any risk asset. First, do you really, truly get what you're buying? This is your conviction. This is the thing that lets you sleep at night when you're down 50%. And second, is this money truly yours to hold? Meaning, if the price goes absolutely nowhere for 5 years, or even 10 years, can you afford to just let it sit there and wait for as long as it takes? So here's the bottom line. Risk assets can absolutely make you wealthy. They can change your life, but only if you play by their rules. And the number one rule is that you have to be the one who controls the timeline. If you can't say no to the pressure of that 5-year forced sale for a house or for anything else, then you're just not ready to own the asset. Because in the end, winning this game isn't about picking the right price. It's about having the freedom to own the right timeline.
Smash like and subscribe.